Hello, everyone. Today, I'm going to walk you through what I've learned through 2020 after doing 81 private money lending deals. Let's get started. Welcome back, everyone. So today, I want to walk you through just some of the key lessons that I have learned over my career in doing what is known as private money lending deals. And if you want to know what that is and what that sort of deal is, I'll put a link above at the end of the video so that you can watch what exactly this kind of deal is, right? It's a great way to build passive income if you haven't ever done it. And it actually is a fairly passive investment. So with that said, I want to walk you through the performance of my portfolios. And it wasn't just my own investing. I help clients invest too. So across the board in 2020, here are the numbers. We did 81 deals through the year 2020. The average deal size was around $61,000. Okay. So that's just over $5 million in capital that we processed throughout the year. Now, pretty good. We have several teams. We have a team in Columbus, we have a team in Cleveland, and we have a team in Kansas City. And across the board, we've had great success. Part of the reason is because the way that we evaluate deals, we do it from a number of risk categories, and then if that deal meets our risk score, then we proceed with the deal. So I really think having the understanding of what makes a deal risky versus not risky is critical to the deal. And so I want to walk you through some of the key lessons and some of the key things to look out for when you invest in a private money lending deal, so that you're not in a bad spot. And we've all heard stories. If you've been in this business long enough, you've heard stories of people not paying their payments, of defaults, of all sort of situations. And one of the biggest ones was Clayton Morris, very well-known guy. I believe he was out of Indianapolis, and he would take people's money. Essentially, they would front him the money to do the rehab. And lo and behold, he was taking the money and just pocketing the cash. Somehow he's not in jail. He must have had amazing lawyers. But my point is this, is that there's plenty of bad stories in private money lending, right? And so here are the key things to look out for in making sure that you're doing the right deal. Now, the first one you want to do, and probably the most important piece, is the team, right? And some key things to consider. Now, I've worked with small teams in the past. I've worked with big teams such as now. And when I say small teams, I mean, is it a mom and pop shop? They have one or two contractors doing the entire job. Is it one person that does the books, does the payments, all of that? The problem with small teams is that they're usually not organized. They're clearly not experienced enough to have scaled up the business. And so across the board, execution is not going to be as flawless nor as fast as a big team. And one of the key ingredients to private money lending deals is what is called points. And again, the video that you'll see in the end goes through what that all means. But the whole idea is to turn your capital as fast as possible, right? So if you have to wait 12 months to get your money back, you would have only collected a point or two in that time. Whereas if you do 4 deals in a year, you're recycling the capital, getting the points, and your returns are much higher, okay? This can drive a return 6 to 8% in difference. So longer projects have lower returns, faster projects have higher returns, okay? So small teams are dangerous is what I'll say. Big teams have backup plans. And what I mean is, if you have a foreman on the job, they in a big team, they probably have several foremans, and they probably have several crews. So if one foreman quits or goes to the hospital or whatever the reason may be, there's a backup. So the project's always moving. They usually have segregated functions in the company. So someone's doing the accounting, someone's doing the books, someone's doing the selling of the property, across the board, right? So you have a better execution, you have a speedier turn on your capital, and overall, you're gonna make more money in the process. Okay, so the size of team is really critical. 2, the incentive for the borrower in the deal, right? So again, in our risk analysis in our deals, we take this all into account, right? What is the incentive of the borrower in the deal? For example, in our risk score, we want to see at least a $7,500 profit in the deal for the borrower. One, things always happen, right? So they tear down a wall and they might find mold. Well, there goes their profit, right? What is their incentive to complete the job? There isn't any. So we want to see enough margin in the deal where there's enough upside for them to follow through on their word, pay the payments, and everyone's happy, right? And I'll tell you, over those 81 deals, the average profit's over $20,000 for our teams, right? So there's a lot of incentive from the profit standpoint. So again, that's a really important ingredient. What is the incentive for the borrower in this deal? The bigger the incentive, the safer the deal is. Three, a really important ingredient is the actual product itself. What are they buying? Are they buying a mobile home? Are they buying a home that has some odd layout? Are they buying a home that has 4,000 square feet that might have a very small buyer pool? You want to have a product that is easily sellable in the market, right? It's very marketable. And again, this goes into our risk score as well. But you don't want to be looking at a 1-1 situation, one bedroom, one bath. You don't want to be looking at a 6-bedroom, 4-bath. Something like 2 bedrooms, 1 bath, or 3 bedrooms, 2 bath. Even a 4-bedroom, 2-bath is completely reasonable. When you start getting outside of those bounds, there's additional risk in the deal. Okay, so really important to consider. Also the product. What sort of product are they borrowing against and trying to flip? Which brings me to my next point. What is their exit strategy? This is a really important piece to know. If they don't understand how they're going to liquidate the property and have a backup plan, then that might be trouble down the road. So one thing that we do is we say, okay, well, we measure what is called cash burn. So as they're holding a property, if they can't sell it to the broad market and they have to make it a rental property, for example, will they cash flow? Okay. I bring this up as an exit strategy because you almost want to have the ability to sell the property on the broad market as well as a turnkey rental to an investor. That gives you 2 options on the liquidation. And again, reduces the risk in the deal, increases the likelihood that they will liquidate the property and in turn, give back your capital. Okay. So those are all the key things so far. Now, another piece to that is understanding, okay, well, what is the desirability of the area of the product, right? So how good is the neighborhood? How good are the schools? Now, this is not necessarily a deal killer. If they're selling the property as a turnkey rental property or just a rental property, the neighborhood doesn't matter as much, right? Now, if they're just doing a flip, a neighborhood and school district absolutely matters, right? As does crime ratings. So again, in our risk score, we do look at that as well. I encourage you all to do the same thing. And so that's a big one as well. And then lastly, just from my own advice, what I will say is that whoever you work with, when you find the deals, really try to build the trust in the partnership. Don't lend right away. Get to know them. If possible, go to dinner, meet them. Who are they? How do they act? What are their mannerisms? Do they have integrity? Those things actually matter. And all the people that I've worked with in Columbus, in Kansas City, in Cleveland, I've had dinner with, I've sat down with, I've got to know them. And before I ever gave them a penny, I wanted to know who is getting my capital, who is getting my client's capital, and are they able to be trusted, right? And so that's something really critical is you need to build trust when you're doing these transactions, because otherwise it's just a word, right? You really don't know who these people are. You don't know what they're doing. So I highly encourage you to get to know the team, get to know how they execute, the size of the team, what their experience is. And and I think if you have all those things in order, the likelihood of you having a failed deal is very low. Okay. Thanks for listening. Really big favor, if you could, we're trying to bring you more content as the days go on. One thing that will help me tremendously is if you hit the subscribe button, and so we can grow this channel and grow the ability to drive more content to you all. Thanks.